Hello, everyone, and welcome to another episode of the What the Finance podcast. So, on this week's episode, we're happy to be hosting Dominique Mielle, former partner and senior portfolio manager at Kenyon Capital, a $25 billion hedge fund. And she is also the author of the recently released book, Damsel in Distress. Well, I think it's about a year now, so it's been out for a year, but still been doing very well. So Damsel in Distress, My Life in the Golden Age of Hedge Funds. So Dominique spent 20 years as a partner and senior portfolio manager at Kenyon Capital. And in 2017, she was named one of the 50 leading women in hedge funds by the Hedge Fund Journal EY. Dominique was one of the only senior women in the hedge fund business and played a key role in complicated bankruptcies, serving as leading creditors committee member of Puerto Rico and restructuring committee member for the US airlines in the wake of the September 11 attacks. So Dominique, thanks for joining the podcast. And just on to my first question, really, what influenced you to write the book?
First of all, thank you for having me in the very lengthy introduction.
Yeah, sorry.
I read a quote before I wrote the book from a woman who was attending an MBA program who said, there are no women voices, no examples in the finance industry, which makes women and minorities opt out of the business. And I thought, why don't I write something that makes them opt in? And looking around for books about hedge funds, in finance in general, but particularly in the hedge fund world, what you have is books that are only by men and white male at that, that are very serious and really quite unapproachable. It's all about these godlike people who've been called to Wall Street when they were 5 and have never lost money and never had a bad trade. Who can relate to that? That's really, at least to me, that was neither fun nor inspirational. I wrote a first article that got in a magazine and people thought it was funny. So onward, I wrote a book.
Yeah, it's the next step, isn't it? And I think hedge funds, they have this almost mystique behind them, don't they? As you said, it's like everyone hears about them all the time, but what do they really do?
They do. And I think media want to present them and how from the inside, hedge fund people, hedge fund managers want to be pictured. And it's always this, as you said, mythical type of portrait. And it's not that. It's a job that, first of all, is great fun, very thrilling, very intellectual. But, if you think about the image of a hedge fund manager you get from one of these books or TV or radio or Bloomberg, it really is about being a deal maker, more appropriately, a very sleazy one, or on the opposite end of the spectrum, a complete math wizard, one of those genius nerds. And really, it's none of it, or it's all of it, whatever you want to think about it. But I think the qualities that the job requires are much more diverse than what people let you know. So it's about creativity, it's about imagination, it's about listening, it's about negotiating. And if you present it like that, there's no reason why women, minorities, why a very diverse group of people couldn't do the job very well.
Yeah, and that leads on to actually one of the questions I had. So in the book, and I found this, it was a really interesting quote and sort of stayed with me. And I guess I'll say it now. So the job of investing is highly creative and that the qualities it requires are imagination, ingenuity, and guts. And as you said, it's like the complete opposite to what most people think, math wizards, geniuses who just, crunch all the numbers. So I guess, why do you think there is that focus on the quantitative side? And why do you think, this is what is actually required to be successful in these businesses?
Well, let me be very honest. Can you do the job? Are you going to enjoy the job if you hate numbers? Probably not. But are we launching rockets into the moon? Is it a job that's highly technical in math? I don't think so. But apparently it sells when you describe it that way. It's one of the favorite ways that papers like to describe the job. But what I did, which was distressed, restructuring, bankruptcy investing, junk bonds, it's a whole different universe. It's about understanding companies. And to understand companies, of course, you have to look at financial statements, but you also have to talk to people. You have to listen to them. You have to ask the right questions. You have to deduct the right conclusions. And bankruptcy, restructuring, it really is about getting a company out of Chapter 11 or Chapter 7, which means having a plan. To have a plan, you need to rally all creditors around your plan. You need to think about what financing needs the company will have. How will it look like? Not if it's a retailer, how many stores should you keep? Where? How big? What management team? What kind? So that's on the asset side. And on the liability side, what do the senior creditors want? What do the vendors want? What does labor want? All this really has very little to do with being a math genius. It has nothing to do with it. It has to do with being able to look at complicated issues and boiling them down to simple messages, simple solutions, and again, being creative and in how you're going to resolve a pickle, which is a company that's in distress.
Yeah, definitely. And that's, I guess that was a great explanation of what distressed investing is. And I guess the issue is there's so many stakeholders involved, be it the management, as you said, the employees, sometimes the different shops, the investors, the debt holders, all these different things. So for you, it's trying to figure out how to, I guess, not make them all happy, but how to get to the point where the business does well and then hopefully your investment does well.
I will tell you, Anthony, a good deal is a deal where no one is happy. That's my conclusion after 20 years of more than that of negotiating is when all parties are unhappy, you got yourself a good deal. But you're exactly right. It's like if you think of it as some kind of board game, it's either a game of chess or a game of risk where different parties have their turf, have their territories, and they move their peons. They have each in turn their move, and then it's yours, and you have to anticipate what others are going to do and how you want to position yourself. That really is what it is. And if you think of if I think of movies or TV shows that relate to my job, I think it's a lot less billions and a lot more Queen's Gambit. Really, that's the kind of framework that I would think of if you're going to go into the business.
That's very interesting. I recently spoke to someone, Alex Gurovic, who's another hedge fund, I think in the West Coast as well. And he's sort of similar. He's very much that strategy based, and in his spare time, all he does is strategy. So it's interesting. That it's almost, as you said, that's what it is. It's the strategy, and because there's so many moving parts, it's trying to make, control them all as much as you can.
Exactly.
Yeah. And then you said there, which I found quite interesting. So when all stakeholders are unhappy, does that mean that they've all compromised? So, there's this thing in the middle where, they're all unhappy, but it's the best thing for the company?
That's exactly right. I've never had a deal that's a balanced outcome where somebody is 100% happy and got everything they wanted, because by definition, then that's not a good compromise, right? So yeah, usually the outcome is everyone got some of what they wanted, didn't get everything they wanted, but it is the deal that made everything move forward and agree. That's usually how it works. And by the way, it's not only in finance, right? It's pretty much in every. It'll be in your marriage if you're lucky.
Yeah, it's a good skill to have, I'm sure, being able to balance all these things. So, in the book, you mentioned how you got into the industry in about late 1990s. And then from there, early 2000s, it was quite success. You were quite successful, and the firm was quite successful, and a lot of hedge fund managers were quite successful as well. So I guess, why was distressed investing so successful during that period? And, do you think there were any reasons for that?
I do. I think distressed investing really dates in earnest from the 2001, 2002 periods when a few things were happening in the market. One, the dot-com and telecom bust. The dot-com bust, these were mostly unlevered companies and mostly companies that went bankrupt but only had stocks. However, the telecom business, and most people don't make the difference, but there was an enormous telecom crash around the same time or shortly after. And those companies had a ton of leverage. That's how they were built. They were heavy in infrastructure. And we're talking fiber network, wireless companies, towers, names that you wouldn't even know if you're in your early 20s because they flat out disappeared. So that created an enormous amount of bankruptcies, distressed assets. And then on top of that, this was in a time where corporate malfeasance was really rampant. Before we had what in the US is called SOX, which is basically the obligation of CEO and CFOs to sign on to the financial statements. That didn't exist before, and that led to pretty wild and outrageous behaviors. And this is when you had bankruptcies of Enron, you had Conseco, you had Tyco, and these were big, large companies. WorldCom was one of the biggest. And so what happened is you had an enormous pool of distressed assets, this nascent industry of hedge funds focusing on distressed, one of the first ones being Farallon, but Canyon was not far behind. So we were literally swimming in distressed assets. There were, I think I did the math, but 15 more times distressed assets than there were distressed hedge funds going after those opportunities. So it was a very, very fruitful time. That's how it started. The returns were fantastic. I mean, we're talking 20% returns at a time where the stock market was doing very badly. And of course, investors took notice, and the rest is history. Money came in, very quickly and in abundance.
Yeah, well, I think in the book, WorldCom was one of the ones that you didn't do too well off, wasn't it? Am I correct?
That was one of my worst early trades. I've had many, many bad trades. In fact, that's the other myth, that good hedge fund managers don't have losing trades. I consider myself having a great career, and I had many, many bad trades, and I make it a point to really tell you about them in the book because A, it's funny. Retrospectively, it's not funny when it happens. But B, that is the job. The job is you are going to be wrong a lot. The trick is not to be more wrong than right. But all investors are wrong very, very often. And you pick it up and, move forward. WorldCom, I made a horrible trade buying bonds literally a few weeks before the fraud was discovered and released publicly, and the company filed for bankruptcy in this massive, messy process that lasted for years. Horrible.
Yeah, as you said, it's a lot nicer looking back on it and laughing at it compared to the time, I'm sure.
At the time, I'm not gonna lie, you either want to puke or cry. Pretty visceral physical reaction.
Yeah, 1 to 10, there's no in between.
Right? Better though, losing money, failing is not a bad trade to learn. It's actually very helpful in life to have a business where failing happens often, is very public, right? Because everybody knows you lost money. It's right there on your P&L. And yet you got to show up the next day at work, right? And you got to work harder because you have to make up the money, and there's no hiding. It's actually, I find it a very it, it's a very helpful skill to have in life.
Yeah, definitely. I guess it happening early in your career as well is probably great, because it means that, say, I'm sure there was still losses in 2008. I think you mentioned the book, but it means that you're maybe not as over leveraged, or you're not as rich because you have experienced those losses potentially.
It's always a question of measure, right? Losing money early in your career, as long as it's not career threatening, is fine. But I suppose you don't want to lose too much money in the beginning, because that would probably be the end.
Yeah.
Well. But yeah, it is very true. What happened in WorldCom is I bought bonds that were very, very short maturity. So they were very high up in price, but they only had a few months to go before getting paid off. And I made the calculation that they had enough money, except that I didn't forecast the black swan of a massive fraud. And that was a lesson that if you're going to put on a trade with a low probability of a catastrophic return and a high probability of a modest return, you'd better be incredibly sure of your odds. Incredibly sure.
I found it interesting because you entered the sort of hedge fund industry with Kenyon, and you had investment experience, but you really didn't know what you had to do. I think you said you were sort of thrown in the deep end and had to learn a lot of it yourself. So I guess I'm not sure if that's correct or not, but if it is, sort of, do you have any advice for other people who may be entering the industry and maybe are in similar situations? How can they get to the point where you are and just learn as much as they can?
So I was an investment banker, a junior analyst at Lehman Brothers before I joined Canyon. And in between, I went to business school. So I had some experience in banking and looking at financial statements, obviously. But really, the job of a junior analyst at one of those large shops is very, very different from being at a hedge fund and being an investor. I'm sure some of the listeners or your friends have had an internship or a short stint at Goldman or JP Morgan, and you're an executor, right? You're basically, at least my job was mostly putting together pitch books and making sure they were pretty, and doing that, 80 hours a week. And you learn, but what I think is the learning experience is more about learning to work a lot than acquiring a specific skills. And there's something to be said for learning to be resilient and putting the extra mile in your work. That's certainly a valuable lesson. But in terms of actually knowing how to look at a bond or a company, or what to look for in a 10K, I had no clue, none. I mean, I would read the same page over and over again and think, all right, well, that sounds good to me. What am I looking for here? How do I find the $20 bill on the floor that nobody's picked up? And there was no one to teach me because the firm was very small. We were literally less than 10 people. So you just had you had to mimic, you had to ask lots of questions, and just go day by day, one step at a time. And honestly, that question comes up a lot. What advice would you give people starting? What advice would you give your 20-year-old self? And the answer is always, first of all, I wouldn't have listened to my own advice. I don't know that I wanted an advice. And other than stick with it, if you're interested, figure it out. You got hired. They want you there. They think you can do the job. So it's just a matter of actually doing it, day by day.
Yeah, because I think you say in the book it's harder to get in than to actually learn it. That's the real big hurdle, isn't it?
My I really have a conviction that the learning ability of people is very vast, especially you're talking about people who have pretty good education, who are very motivated, who have energy and enthusiasm. So I mean, these are pretty amazing starting points.
Yeah, definitely. And I think it's something that you mentioned in the book. And I guess there's this thought that sometimes, people who are distressed investors and maybe almost like vultures, they come in after, at the roadkill and try and pick out all the best pieces. But I guess I think you provided quite a good explanation about why you don't think that's the case. I'm not sure if you can talk about that now.
I think it's only partly the case. Do we look at companies that are in bad shape, like vultures look at skeletons and carcasses? We do. But then to make money, you have to do something out of it. If you buy a bond at 30 cents of a company that is in bankruptcy, you're not going to make money unless the company emerges with a solid plan where all the creditors have signed on and you've provided value through the bankruptcy process. So I think the image is sort of the starting point of the job, not the end point. And the fun and thrilling process is to spot sort of a moribund company that has potential, and it might have potential because of its assets. The business was badly managed, or it was too big or too small, or one subsidiary is good and the others are bad, and you have to shed some assets. Or it's a good potential business with a bad capital structure. So it simply had too much leverage, and you get to cut that through the bankruptcy process and reemerge like the phoenix, and making a rising business again. And all of it is really interesting, fascinating, really, and more or less complicated. Some processes are not that difficult. You're in and out of bankruptcy with a pre-approved plan, and it's all about shedding some debt and closing some stores. Some are very complicated, like PG&E, like Puerto Rico, because they're big companies or big municipalities. There are lots of parties involved, etc.
Yeah, and I think one thing that I read was when you were looking into airlines, and a lot of the contracts were to do with sort of the ownership of the airplanes, which I found quite interesting. Sometimes it's just to do with the intricacies of going through the nitty gritty, finding the best contracts, the best terms, and then from there, it's best for the actual company.
Exactly. And again, we're back to sort of this board game where you have, you imagine the capital structures as being the different peons that you can pick with all different terms and as you said, specificities in it. And there's detective work going through the documents, going through the scenarios and how those different securities act under different scenarios, and picking the right one with the right weight, sometimes picking different ones and having a position that's short one, long the other, or of different quantities of different layers of the capital structure. That is also that's great fun.
Yeah, I'm sure, especially when you find that really good contract, or that's I guess that's where the real I guess pride or excitement comes, when you're like, oh, this is really good, let's go further into it.
Exactly. There is really a moment of trepidation and excitement and victory when you found a bond in Puerto Rico, for example, that is trading just the same as a general obligation, but happens to be a bond that was backed by a government program that pays the interest, and is 100% safe on the interest side. That is a moment of really jubilation.
Yeah, if I could imagine. So the industry has changed quite a lot since you started over the past 20 years. And how would you say it's evolved since 1998, early 2000s to the current stage it is now, hedge fund industry?
I think in many ways it's evolved like any industry does. So if you had a business class of any kind, they'll tell you that an industry moves along an S curve. So it has a very sharp exponential growth phase from the beginning, and then it hits a flatter part of the growth where the business is competitive. There's a lot of pressure on prices, and growth goes into the single digit. That's what's happening. So back in the early mid 90s, the business was nascent. There were, hedge funds in general, and distress in particular, but I think there were less than 5,000 hedge funds. And then from I would say 2000 to really probably 10 years ago, the growth was rapid, unabated. Assets in some years doubled. There was a brief stop in 2008, but it picked up right after that in 2010 to the point where now hedge funds control some 4 trillion in assets. There are 20,000 of them. So it's become an institution from a very entrepreneurial kind of scrappy secret business that nobody would have heard of. It's now an institutionalized business, an enormous market force, one that's very well known about most people on the street, very well covered by the media. And so the ability to perform has changed, the ability to charge high fees, the role of hedge funds in the market, all of this has changed a lot. But the one thing that hasn't, and again, that we're back to why I wrote a book, the one thing that hasn't is that it's still, for the most part, run by men, and mostly white men. So that's a little bit strange to me, that because usually with maturity comes diversity. Most businesses, when they reach a certain size and scale, they realize that they can't get their resources from just a tiny little pot. No business, no industry restricts its talent, but really its supply, its resource management to whatever, 10, 20% of the world's pool. And people are the resource of hedge funds.
Yeah, that makes sense. And I think a really interesting point in the book that you mentioned was, you said before where 15 times, there used to be 15 times the amount of distressed assets as there were actual, money from the hedge funds chasing it. Whereas now it's a lot. I think there's too much money chasing it. Yeah.
Think about it. When COVID hit, early 2020, it was going to be a bonanza, supposedly, for distressed hedge funds. But when you dig into it, first of all, the distressed episode was very short. I think there was something like 1 trillion distressed bonds in March, and that totally evaporated within 3 months. The biggest bankruptcy case was Hertz. Now, Hertz only had 26 billion in assets. If you compare that to one fund, the Oak Tree Distress Fund that was raised at the time, which was some 15 billion, right? And then you think back in history, okay, what was the biggest case in 2008? In 2008, it was Lehman, which was 600 billion, right? Compared to a distressed funds that were a fraction of the sizes of what the large guys are raising today. So there's an imbalance that's totally flipped. There used to be lots of opportunities and a small pool of capital. Now there's a huge pool of capital chasing a small, fleeting pool of distressed assets.
And we saw the Fed as well buying CLOs and a lot of that, distressed debt, and as well. So I guess that's the issue, that you could say that that macroeconomic change and the monetary change as well has made it a lot more difficult.
Oh, totally. I wrote an article where I coined the phrase that the Fed is the Grinch who stole distressed. That is a massive change in the business, a game changer, and it's pretty new. This ability and willingness of the Fed to conduct what we call QE, quantitative easing, it's an action that they really started in earnest in 2008, and they've done it ever since. But it's, in the history of the financial markets, it's a new occurrence, but it's become so routine that the question is not even whether the Fed intervenes in every crisis, it's how fast and how big.
Yeah, and I think you mentioned liquidity in the book as well, and that's another thing. It's the fact that they're just pumping all this liquidity into the market, so there's no need for, I guess, that liquidity from the distressed investors.
Right.
Dominique, thank you so much for joining the podcast and talking with me today. And I guess, where do you see the industry going into the future? Do you have any, I know it's a fool's game trying to predict, but do you have any maybe predictions that you think where it could go? Or
look, I think there'll always be a spot for hedge funds in the allocation of institutional and even retail investors. But the form that hedge funds, the shape that hedge funds are going to take, I don't know. I think there's definitely pressure on fees. So that will have to be solved. And it used to be that people invested in hedge funds for performance. Now it looks like it's more for diversification. The good thing about this business is that it moves super fast. So someone, and most likely one of you guys, will come up with a better mousetrap, with something that's new and really attractive to investors. What that is, I have no idea. If I did, I would be in the business right now. But I have no doubt that someone, hopefully someone listening, is going to have a great idea for a new hedge fund.
Yeah, and I guess we've seen so much volatility over the past few years since COVID. So I guess there's that, maybe the opportunities coming back, as you said.
There's that. There's always new things. Crypto, SPACs. It's endless.
Definitely. So yeah, thank you so much again. I guess, the real message that and a lot of our listeners have probably heard is, diversity in the workplace, and it just helps decision making, and it helps, as you said, diversify just opinion, and hopefully prevent systematic crashes like we've seen in the past. So is there any other message, I guess, you'd like listeners and readers to take away from the book and the interview?
That finance and investing can be great fun.
Yeah, it's not as boring as it looks sometimes.
Is it stressful? Is it miserable to lose money? Yes, but can it be thrilling and obviously lucrative? Definitely.
I agree. Definitely. It's a never-ending pursuit, isn't it? So thanks again for the interview. I'll put all the links to buy the book down in the description. And then if anyone, do you have any other content? You mentioned you released a few articles. Is there anywhere else people can keep up with you?
Yeah, I write for Forbes. So not on a super regular basis, but you'll find my articles there, and you can find me on LinkedIn and Twitter.
Perfect. Awesome. So Dominique, thanks so much for the interview.
Thank you so much for having me.
Thank you. Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.